All right. Well, I think, I'll just set some context while we're waiting for Masha in a moment. But thank you all for coming. Today, we are going to talk about navigating this fundraising climate. And I'm so grateful, actually, that these three VCs who see a lot and also have had portfolios for many years now, can share their experiences and what they're seeing through their portfolio companies and also what they're also seeing in the companies that they're looking at. I think many of you want to know, is this a good or a bad market? So maybe we'll just start with that as a very high-level question. Are we in a good or a bad market for fundraising?
I always have a tough time with that question because I don't know if it matters. So I would say right now the environment is definitely good for some companies. We all know that AI companies can kind of raise whatever valuations they want, as much capital as they want, $2 billion as a seed round, whatever it happens to be. But I think that there's plenty of capital out there for the most part in most markets, especially at the very earliest stage. It gets harder once people are looking for data, but at the very earliest stage, there's typically plenty of capital out there. And so the question of whether it's a good or bad market, it doesn't help you. What would you do differently, really, if you knew it was a hard market versus a good market? Because maybe that's what you should be doing in the first place. If you knew it was a hard market and you had to focus on building your product, focus on your customers, all that stuff, shouldn't you be doing that anyway? So I guess it's definitely hard for some companies. It's easy for other companies, but I don't know that knowing the answer to that question really changes.
Yeah, I think that's fair. And actually, I would further add context that Jake Gibson was previously one of the co-founders of a company called NerdWallet, and you guys largely bootstrapped until the later stages when you raised money, right? And so you got started.
We started in a very hard market.
In a very hard market. So that's his perspective, and I think that is absolutely true. Any other thoughts on this question?
Yeah, I think the market is hard or easy. I mean, to Jake's point, depending on who you are. And it feels like it's more bifurcated than it's ever been. So I feel like if you're a top 1, 5, 10% startup, it's probably never been easier to raise.
And what does that mean? How do you know if you're a top 1% company?
Yeah, so that's a great question. I think it's some combination of narrative velocity, so just being in the zeitgeist, building in hypey themes, agents, co-pilots, etc. Just being pedigreed as a founder, raising from a top AI fund. I also think there's I'm also seeing a lot more founders being able to get this meaningful distribution before raising money. So I think that distribution velocity is a part of it. So I'd say zeitgeist velocity, distribution velocity, some combination of those things. So I think it just really depends on where you're standing.
Mm-hmm. Are you guys seeing any, do you have any thoughts around valuations? They seem like they're kind of all over the board. Jake had kind of alluded to these really frothy rounds, but then we're also kind of talking about how it's hard to raise. Masha, do you have any thoughts on this?
Well, I think, first of all, speaking about the market, I think we still operate in circumstances of big macro volatility. It's just uncertain, what's happening on the macro picture. And I think as you're managing the fund over a few years, you notice how much of what you do as investor dependent on where you are at the market cycle. And I think it's really undefined. There are days when it feels to me it's 2021 back, except it's not crypto companies rocking it, more defense deep tech companies, right? There are days when it just feels very dry, and I think it's just unpredictable market, and I think the way how investors feel about macro would definitely reflect on their day-to-day decisions. So I wouldn't say it's easy. I do think it's definitely a good opportunity for companies in a number of fields like AI and deep tech. I do think it's became much more polarizing just in terms of how important the sectors that you're leaning on. And first time I worked in VC in 2010, being a part of another fund. And I feel over the last years, importance of the theme and topic has only been increasing. But said that we just got 10 unicorns that we invested on seed stage, and we've been operating for 6 years. And this company is not AI, this company is enterprise SaaS, and you might think it's not the best to be raising unicorn rounds and like this year, but yet founders who has been consistent operators and who just kept executing on their thing, been quite resilient towards overall waves on the market.
Mm-hmm. So I'm hearing this theme of like it's a very bifurcated market, but to really help folks out in understanding what it is, like people want to know, am I on the side of I'm going to be able to raise money easily or am I not? Like how are there some things that you're noticing that are patterns on either side?
Well, I would say that like everybody thinks they're top decile, right?
Yes.
Like every VC thinks they're top decile, every founder thinks they're top decile. And so it's another one of these things where like, the market is going to give you the hard feedback one way or another. And putting yourself in a bucket isn't necessarily going to help you. I would say like, I think we all got spoiled a lot, especially that like 2020, 2021 timeframe, but even everything leading up to that, like we were in a zero interest rate environment for more than 10 years where the amount of capital flooding into the space was just unbelievable. And I think we kind of got to this mindset that like that was normal. Like everybody's fundraising, there's announcements in TechCrunch every day, valuations are getting higher, all of your friends are fundraising. But now we've just kind of retreated back to, actually it's still pretty frothy, but like more of a normal market than like what we had experienced before. But at the same time, we have like 100 times more founders and 100 times more startups. Mm-hmm. And so, and a lot of capital in the venture space as well. And so I think there's just like, we just kind of have to get used to like, things are supposed to be hard, right? Like starting a company and building a business of any sort of meaningful value is supposed to be hard. And so like, what that means is you just kind of have to, no matter what the environment is, no matter where you think you bucket, it's just a grind. Like you have to spend as much time as possible talking to investors, talking to customers, and to set yourself apart and to kind of become this like, this narrative or to have this velocity that people are going to get excited about, like you have to create that. Like unless you previously sold a unicorn, obviously like that's going to check a box for a lot of VCs, or you were one of the first employees at Stripe or something like that, then you kind of have to create your own narrative and create your own velocity. And all that comes from, the only way you can do that is be in a big market and have an extraordinary like pace of execution, be able to demonstrate that what you're building is creating some enormous value and that you can prove that. And then that'll get people excited. And like focus on what you can control really, because you can't really control like your LinkedIn profile at this point.
That's fair. What do you think about valuations? Like what is a typical, everyone likes to ask, what is my valuation? And it's such a hard question to answer because everybody is all over the place. But how would you think about that? Like if you were going out to raise as a founder today with your startup and you're running around with your safe, like how do you think about how to have that conversation with investors?
Scale of idea and uniqueness of the market is something that's been massively defining to the valuation. I think it's almost like two types of valuations. One valuation in AI space and it's just fully disconnected from the rest of the market. And as an investor, you really don't have advantage of looking at AI valuations as something that you would compare with anything else, even though if you run generalist fund and then the valuations from the rest, I think modern Series pre-seed became like seed and Series seed became like Series A. We can definitely see lots of inflated pricing. And it's almost like valuations been somehow manufactured by amount of checkboxes that founder met and the ability of founder create and extend momentum. However, I could also say it feels like all the companies that I work with right now is kind of like on constantly fundraising mode. And it feels to me that right now, it used to be important to create momentum like once a year, once every 2 years around your fundraising. It feels like right now, founders need to create and extend momentum and they don't have a time to take a breath in between and they have to be equally good in creating vision, building, but at the same time, constantly pitching their vision to investors and also to the talent. And I think one of the biggest factors in that is also like war for the talent, because while amount of money coming in is increasing, and the amount of attention to tech is increasing. At the same time, we don't have this skyrocketing amount of high quality talent that come into the market. And despite AI, we still need more of this talent. So as you need to create this momentum, you need to always think about, do I have enough resources to hire the best people on the market, because competition is so hard.
Mm-hmm. I think one of the tricky things, though, is I'm also seeing a lot of AI companies who can't raise, because we're now in the era of AI is no longer new. Like, you know, if you are a fast follower or a slow follower of Cursor, at this point, it's honestly just going to be difficult for you to raise, right? Like, there are so many copycats of just about every major AI idea out there. So I think you're also battling this idea of, well, this is a very competitive market, and VCs are just passing left and right on a number of AI ideas as well. So I don't know what the right advice here is, but it sounds like it's test the market and then quickly adjust if you can't raise or have difficulty raising.
And I think that one of the things that's like counterintuitive at the earliest stages in terms of valuations is that it's not based on any sort of quantitative analysis. It's just based on supply and demand. So we don't look at revenue multiples or like EBITDA multiples like you would in the public markets when you're looking at an early stage company. For a lot of companies, revenue doesn't exist, EBIT doesn't exist, or even if they do exist, they're not relevant to like what the long term looks like. It's not what we're investing in. And so the valuations typically just come down to supply and demand. So if you only have one term sheet, or you're just cobbling together a bunch of safes from other investors and there's not even a term sheet, then you don't really get to decide your valuation. The market tells you. If you have a lot of term sheets, you know, you've been able to kind of put yourself in one of these positions where you're like a hot commodity, then, you know, obviously you're going to command a higher premium. But that's the only thing that matters. You like, the actual metrics aren't what's going to drive your valuation. It's just supply and demand.
Totally agree. I mean, and just to spell it out, that's supply of your round and demand of investors. That being said, traction is something that influences on some level demand of investors, potentially, depending on what it is. Let's talk about that for a little bit. You know, pre-seed generally don't have a whole lot. I'm seeing people talk about a seed hurdle, like getting to seed is a lot harder than perhaps a year ago. Is that true? What do you think?
Yeah, I think that tracks with what I'm seeing. Like, it feels like the market's flooded with just like pre-seed stage companies that have raised, you know, between like 500K and 1.5 or 2. But then the hurdle, the bar to clear for seed is like much higher than it's been. And I think like one thing at Weekend Fund that we've tried to like pay a lot more attention to is just like retention, as well as like repeatability of go-to-market, like even at the seed, compared to like 2021. And I feel like some of that is like that like investor discipline coming back. So I think it's really like at the pre-seed, it's like, can this be interesting? And at the seed, it's like, can this be big?
And this is where you start to see, oh, maybe this can't be so big because of how their traction is going? Is that just spelling this out?
Yes, and also like the repeatability of the go-to-market, retention, etc.
And is there a number that you look for? I know it's still all very fuzzy, but just in your mind, is there a number or not so much?
No. Yeah.
No.
I think when I look about like pre-seed versus seed, I think about seed as I pay a lot of attention on ability of the team to quickly build and iterate on the product. And one of the things that you can define when company go between pre-seed and seed, how quickly this team can assemble product, which comes down to ability of this team to pick, recruit, retain engineers. And as I invest in founders, I would either choose engineering founders who would do a lot of this work, because it's very often you move faster as pre-seed to seed when you have like someone in-house who's just like building the product, and it's very often founder and first 2 team members. But it's also like, does this founder has unique channel where they can quickly recruit engineers, because it comes down to the ability building working product fast enough. So, and here like all people like, say like founders who has like big followership on Twitter, or founders who came out of Stanford or MIT, or founders who's been like part of like Thiel fellowship, any founders that came from community and can have like unique talent source have a significant advantage, because that does verify for me the ability to build product fast enough, assuming that I'm on board with their vision.
So let's talk about that. At the same time, we're also seeing companies have fewer people than ever as well. And I saw some crazy stat, like 25% of YC companies are largely vibe coding 90% of their code base or something like that. Don't quote me on that, but something crazy. What do you think about that? Like, do companies need a lot of engineering talent? In fact, actually, can't their cost structure be a lot lower? Is that what you're seeing in your portfolios? And is that what you expect from future portfolio
I think if you come, even if it comes to AI and you think about companies' abilities to turn technologies that foundational models offers them and just to turn it to the product that's actually solve customer need, because it's very often like there is a technology and then customer tries a product and product is just not good enough to be using. And as companies go to customers, they start finding out, well, there's like not 2 but 4 categories of customers, and this customer wants this adjustment. So I feel like if company is customer focused, they still they have lean engineering teams, but they still unable to run entire organization with like 2-3 engineers. I feel like the more customer focused, the more they forced to have more engineers than less. However, I can say that on business side of things, there is a lot of AIs that optimize BD function, sales function, marketing function. So I could say it does actually, AI does decrease the need in terms of like building out distribution, go-to-market. But I don't think AI necessarily makes it easier for them to build quickly enough product, because if they really want to hear customers and keep adjusting it to satisfy their needs and truly help customers build their revenue, they actually need good amount of engineers still. But they can save up resources on marketing and sales and BD.
And I think this actually leads to a broader question of, when you guys are looking at ideas to back, how much does defensibility of product matter? Like, is anything defensible these days?
The way that we think about defensibility, I think it's too hard to predict at the earliest stages. And I think the only thing that's truly defensible over the long term is just out executing and kind of speed of execution. But if we've seen 100 of the same idea, that doesn't just tell us that like this isn't defensible. It just tells us that like this isn't necessary. This is going to be a super crowded category and not necessarily one where we're ready to underwrite a bet at the early stages. So this is the way that we think about defensibility is just like, if everybody had the same idea at the same time, it can't be that great. Whereas things that are like new and novel, potentially more defensible, just because like you can get out ahead of everybody else and kind of build faster and have something that solves a unique customer pain point in a way that there aren't 1,000 other people already doing.
Definition of what defensibility is changing. I feel like for me, lots of that uniqueness of team inside about the customers, and do they have customer obsession in the culture of the companies, and how much of the time they actually spend talking to the customers. I feel like you can identify such things from the very beginning. And you could see it even in founder language, either do they speak about customers and their need or not, or it's all about organization, or is it all about fundraising? You can definitely see it through the language. I do think customer obsession is a high defensibility, not necessarily a unique solution, but just this closeness, and almost like the best founders, they have to like spend with customers like half of their entire time. And it's often this time is like unproductive. It's like more researching about like what company is up to. For example, I have like AI for policing software, and founder went on like 20-something ride-alongs in the course of like 6 months, right? That gives me a strong sign that, well, that's a defensibility, not just his technical abilities. I think two is just like resiliency and ability to not depend on external circumstances and be very resilient towards their vision and not paying attention to too many ways, being like almost insensitive to where the market is, because no one knows where the market is going to go. So you really want to pick founders who are very committed and very faithful and long-term oriented in terms of, that's how I define defensibility. But I think like having this feature or this partnership is not something that I define as a defensibility. So definition of defensibility has been changing for us, for example.
Yeah, one thing we index on pretty heavily at Weekend Fund is looking for an insight. One thing I really try to look for is on like pitch calls is the founder able to deal in specifics about the customer, or are they talking about the customer in abstractions? And also to Masha's point, like I think there's a lot to be said about just like the magnitude of customer interactions, like the difference between a founder who's spoken to like 10 customers, 100 customers, and 500 customers. I feel like that's very nonlinear in terms of outcome. But because we invest early, like sometimes this insight isn't really like crystallized. It's not like, crystallized to the extent that it's like a concrete like product insight or distribution insight. Sometimes it can just feel like nuggets of insights, or sometimes it can even be like earlier than that, which is just like, hey guys, I have like 3 good ideas on how to solve this better. But the specificity of like that content matters a lot, I think.
Totally agree. In the last few minutes that we have, would love to just give everyone sort of some closing thoughts on what would be our advice to anyone who's starting to fundraise either for a pre-seed or a seed round today? Any specific tactical things that come to mind for all 3 of you?
Well, I think first just it's really important to focus on big ideas, and if you have a question, if idea is big enough, or if you have troubles with fundraising, I think it's always like good question to ask if my idea is big enough, or does it feel important enough, and the buzz that's happening. I think we're in the time when we need to keep momentum. Like we can't just have like momentum once a year. Momentum should be nonstop. And I think your ability to have community and to have interaction with all of the investors, and one of the ways for that is just going direct and building in public. It could be, it's really important, and I think it's definitely becomes very important factor for your ability to fundraise. And what's good about it is that you have full agency over it, right? You just kind of show what you built, how you built, and that would be good enough for people to keep observing you. So it's a time when you need to raise, it feels easy and it feels like you have this optionality. So I would highly recommend this. And 3, I just wouldn't, as a founder, I would never like stuck too much trying to time things or trying to figure out, is it a good wave, is it a bad wave? I think in that I would also never like delay raise with the hope to expect that it would be better market conditions. I think whenever you want to delay raise, it's actually like a very good strong sign. Just like go now, and if someone like offering you term sheet for the round you was only going to raise like half a year from now, just take it. I would really not risk delaying this funding moment, and I would always like operate in the sense of high urgency.
I think, at the earliest stages, I think the only thing that really matters is getting to product market fit. And like getting there with as little capital as possible, as fast as possible, learning as fast as possible, doing everything it takes to get to product market fit as fast as possible. And I think people tend to approach this as I have a product and I need to go find a market that fits, when that's not the right framing. I think you need to be obsessed with a problem to solve, not a product. And you need to be spending all your time figuring out what is the right solution to that problem and for whom is that the right solution. That's the product and the market that need to fit. And I think people tend to get too caught up on, I have this idea for a solution and I'm going to go out and just figure out how to sell this solution, when really it's the problem that you need to be obsessed with. How do I solve this problem? And be completely open-minded, and what that might be willing to kind of kill the baby or whatever it takes to figure out what the right solution is to get to that PMF.
Yeah, I would really second that. I'm seeing a lot more like solution in search of a problem companies than I've ever seen since I've started.
It's called crypto.
Also known as crypto. Since I've been an investor, and I think like being obsessed with the problem, but I think being flexible about the solution feels like the strategy to have really high velocity. Yeah, and also like I feel like just from like a tooling perspective, like I build my own side projects on Cursor. It's never been easier to move fast. So yeah, I would just like use everything at your disposal to get to product market fit. And then the last thing I'll say is I just think we're in like a fundraising market that's higher variance from like a valuations perspective, for, like just a lot of things. And the right strategy, I feel like when the world is just like changing that much, is to double down on fundamentals.
Yeah.
Which is like, how do we build an enduring business?
Yep. Completely agree. Well, thank you all. Thank you all for attending our talk. Hope this helped you with your fundraise.